Hello, everyone. I'm Charles Brown with CB3 Financial. We are glad you are here for this special episode of CB3 Live, where I will be interviewing New York City trader Michael Melissinos. Michael is a commodity trader in New York, and here I am in Chicago, the home of commodities. So we have a Chicago-New York connection here. And interestingly enough, we're going to talk about the markets, but we're also going to talk about market psychology. In times like this, when geopolitical and macroeconomic policies tend to be obfuscating, if you will, normal market trends, how do we handle that psychologically when the markets just aren't moving in our favor, either in the commodities markets or in the equities markets? We're recording this in mid-2025, and it has not been an easy year for commodities or for equities, and a lot of it is just simply out of our control, as Michael talks about. And he talks about strategies that he's used and techniques that he's developed to handle these kinds of what we call drawdowns. Most of the time, traders, investors are in drawdowns. A drawdown is any time you're not at a lifetime high, which, believe it or not, is about 97% of the time. All right. And I hope that when you listen to the interview, you hear this and can take heed in some of the things that Michael says. I wanted to show you Michael and his family in this shot because Michael is a family man. He manages to find a way to live in Manhattan and have a family and spare time to do things that he really wants to do aside from investing. And it's important that we all realize that there is a life beyond our money. We have a brand new segment that I hope you guys will watch on the CB3 Live show called Money in Motion. But tonight we're focusing on how we manage to invest in these markets and keep ourselves sane. And you're going to hear lots of tips on doing that. I hope you enjoy my interview with Michael Melissinos. Well, hey, Michael, welcome to CB3 Live. Here I am in Chicago. You're in New York. My first New York-Chicago interview. And it's great to have you here, buddy.
Great to have you.
Fantastic.
Great to be here.
Yeah, appreciate that. So here we are, you as a New Yorker trading commodities for your clients. I'm in Chicago trading equities for my clients. That's the reverse because New York's the home, world home really, of the equities market, and Chicago is certainly the same for commodities. What do you think about the difference culturally and how it shapes traders, investors' minds, whether you are managing money in New York or Chicago or like Ken Griffin, maybe in Miami? How does the location of where you are just make a cultural difference?
Oh, I think this area, New York, New Jersey, Connecticut, we're kind of in a brain trust of Ivy Leagues and high profile schools, high pedigree, and that lends itself to you wanting to figure it all out and want to know why, answer why questions, and predict the future, those things, things like that. And yeah, the commodity, the trend following philosophy that I adopt for my trading is the exact opposite of that. So I clash with people, especially, I have a 3-year-old son now, or I meet a lot of parents who, they go to Yale, they go to Harvard or wherever, and they're talking at length about the reasons. Yeah, I don't know, this industry is kind of, and they're in the business, so they're rattling off tons of information and statistics. I'm like, yeah, what's the trend? Because I don't care about anything but that. And so it's kind of a conversation stopper, or it's a, well, what's your problem sort of thing.
Have you ever thought about using Ed Secoda's line? Well, you're talking about fundamentals, but I really view them as funny mentals because you can't trade.
Yeah, I haven't used that. I'm sure it might play better if I wasn't, say, a baseball player from a Big East school. Ed could get away with it because he's MIT, and it's like, all right, well, instant. All right, he must know what he's talking about. But this baseball player from Jersey, it's not gonna deliver as well. So I just need to be proven right over time, and then maybe maybe they'll come over to my side.
I got it. So you started at Bear Stearns pretty much just before the crash. That had to be an experience, right? So give us a little bit on that, and then how that morphed into you starting your own firm with their venture capitalists, et cetera. And that has to be a really interesting time to start in the market, sort of like somebody starting in 2008, obviously, or 1987 on October 15th, in their career, right?
Sure. I think that time was you learned a lot about. I learned a lot about the importance of basic managing risk 101, and I was also at the time late '07. Just ramping up at Bear, I was fully consumed with working at Bear. The day job was in the office working in a suit at 5 a.m. And then getting home 8, 9, 10, depending on if it was earning season or not. So full blown day busy.
Sure.
And then at that same time though, I was tracking the trend followers performance on a monthly basis, go to their website, stuff like that, like Bill Dunn and Jerry Parker and John Henry was still around at the time and a few other guys. And then I started to learn about the markets more. And then I'm watching these guys and I'm like, okay, now, and this is after reading Michael Covell's trend following book and just immersing myself in what the trend following philosophy is all about. And then I started to get I think I know what they're doing. And then when the big moves came, when Bear went down, and then when Lehman went down later in the fall, those were too big. Oh yeah, now I get it. Now this is one of those events that I read about in these books where they make big money in these big events. So I said, okay, all right. But that was the seed and that was the spark of, I can do this. I can do this. I don't know how to do it, but I know I can do it. So, the other side of that was, though, you learn life lessons when, a 100-year firm goes out of business.
No
and then
kidding.
another 100-year firm goes out of business down the street.
Right.
And you're saying, all right, I thought I was walking into, this high pedigree place. Again, what I viewed myself as, I'm just a baseball player. I'm trying to figure it out, trying to make it here in this world with all these fancy Ivy League people. Oh, but even they screw it up and go out of business. Okay. All right. Now, maybe I gotta have my whole belief system is incorrect.
So were you familiar with credit default swaps and the other super highly leveraged? So it was once the crash happened, then
yeah, you start learning about that stuff. Then it's like, what is this stuff? It's way over my head. And then I remember. I think it was the day that Bear was bought by J.P. Morgan, and I was standing on the trading floor with the most, and I worked at the equities, healthcare, and biotech desk. So I was standing there. I believe it was in the afternoon, with the most senior healthcare equity trader, and no one's around, or people are coming and going because everyone knows it's over. And me and him are standing there amongst all the sea of screens, and he's like, "Mike, don't worry, we're all going to be fine. This isn't important. This is just money. We lost some money. Okay. I'm going to a funeral tonight for one of my daughter's classmates who killed themselves because they were being bullied. They're like middle school.
Yeah.
So I was just like, okay, right. Perspective here. And that was more than, all right, I didn't learn anything tactically about trading or something, but I learned everything about, philosophy of life and go your own way and you really do what you want to do.
Would we call this the hierarchy of values? So you think that trading is everything and the working 17-hour days is everything until you have a friend who buries a kid that was being bullied. And it's like, wow, where's this leading?
Right. I always leaned on the intense side. With baseball, took it very seriously. I didn't know how to turn it off, and I didn't know how to detach that. Oh yeah, I'm Mike. I play baseball. That's the sport I play, not I am that. Because, like in trading, and that was a good segue into our current environment for trend following, at least in the macro trading. We're in a big juicy drawdown. So, yeah, and this is something I spoke with Ed Sakota recently about staying away from the dark side of you attach yourself and your self-worth to your trading performance, or in my previous life, my baseball performance. That in an unhealthy way sways my self-worth, if you will.
Absolutely, no question. And it happens, there's quite a few years between us, you and I can tell you it happens even at this age. So here is a recurring question, and we're a little off script, but that's fine. This is where we're going, and I love where we're going. How do you know when a strategy /system /methodology is just broken? And how do you know when this is a time when we have to hold on because the probabilities will come back in our favor, likely in spades? That's a central question, it seems, whether you're trading equities or cotton futures or I would argue Dutch tulips 500 years ago, right? They probably had drawdowns then.
I would love that trend right now. That'd be great.
No kidding. Well, it did end, though, as we know, right? So anyway, that's a question, and we'll, again, probably have that more than once here. But what do you think about that? How do you differentiate?
Non-technically first, I would definitely quiz somebody on their system. Like, okay, what do you trade? What makes you get in? What makes you get out? What is your basic principles? What's your basic philosophy? Does it go with trends? Will it work in nature? Will it work in other asset classes? Will it work in not just this time frame, this time period, because this is a special situation sort of thing? But technically, I would have someone fill out a risk of ruin calculator.
Mm-hmm.
So I need your average win, average loss, win percentage, what you win in dollars, lose in dollars. And if that thing is above 0, you're in trouble. It has to be 0. So if there's anything above 0, and usually in nature, if you're doing anything that puts you at least an above 0% risk of ruin, you're going to die at some point before you naturally die. So someone's going to kill you, or you're going to accidentally kill yourself.
And you're speaking metaphorically, making sure you're speaking metaphorically, obviously.
Yes.
But psychologically, as you get closer and closer to that 0, which is risk of ruin, that's when it becomes. See, we don't really know in this current drawdown. Now, it's not quite so bad on the equity side where I am, but it's definitely bad in my macro trading, like what you're doing for your clients. On a scale of 0 to 10, if it's going to flip on a 10, are we at a 6? Are we at an 8? That's what we don't know.
Sure.
Yeah.
You never know. Now, that's why we need more and more data to increase your confidence in your belief in what you're doing is correct. And sometimes you just have to know that, all right, like before I got started, from let's say 1980 to 2010, you look at that, a test of a simple few dozen markets, long-term trend following system, very classic trend following principles, and say, this thing looks great. Okay.
Yeah.
Now, it doesn't mean a big drawdown's not lurking out there. That's something that hasn't happened before. That doesn't mean it's broken, because again, it's not dead. It's just annoying. It's just, and this is what I told Ed, a couple of months ago. I said, I'm not losing confidence in it. I'm just being a baby. And I'm afraid people are going to leave right before it gets good again. So you can have a theoretical risk of ruin of 0, but that doesn't mean people won't leave you. And you'll have a no business, because
Exactly.
they don't know what you're talking about. They don't care. They're just like, I'm sick of losing. Like, get me the hell out of this thing.
Right. And then they pick it up and go somewhere else to start over a brand new set of probabilities. This is what I've tried to explain to people. You can leave, but if you're not in this for the long run, I want to quote you here. Predicting is unnecessary and dangerous, and that it leaves you, and you need to leave your opinions and biases at the door. So many people think this is counterintuitive because they want to know the why. I am not concerned about the why, and I'm guessing you don't either. Markets will do what they will do. That's a Tom Basso line. Why is it that we're wired as humans to want to know why, and it gets in the way of sound judgment, both as a client and as a trader?
Fear-based. Most of the world is fear-based. I understand it's survival on Earth type of wiring. If you have dare I say, a spiritual connection, everything's going to be fine. Everything's okay. There is no death. There's a transformation to something else. I don't know what it is, but it's not black light and there's no existence. The consciousness goes on, just in another form. Now, you need to be connected and calm, and you have a way of being that's at a higher state than this survival on Earth state of being, which is where most people are. They're in the fearful, they're judgment, they're judgmental, God's out there to judge you. We got to do whatever we got to do to stay alive and gather more meat for ourselves. So with this,
survival mode and not living. That's basically what you're saying.
Yeah. Yeah. I don't think you're at peace, and you're not operating amongst the chaos calmly.
Have you always
you're getting knocked
found
around?
Yeah. I'm sorry to interrupt, but have you, how long have you been in this place where you can do that? I mean, did this have something to do with Ed Secota's trading tribes or other mental adjustments? Or?
Yes.
Okay.
Yes, I think trading tribe. Yes. I've done another couple of, say personal growth exercises, not in like one sitting, but over say a course of a month or so. I've done some of that with a coach, and tribe. If any of your listeners are aware, it's more about dealing with your feelings that come up in certain situations, and then we typically respond in our whatever our habit of responding is, and it's generally some things can be in an unhealthy way. So we use tribe, go on the hot seat, work on your physical forms. Okay, yeah, this is bothering me, and I do this, and we encourage. Okay, go with that. Keep rubbing, and then you get an aha somewhere like, oh, when I feel fearful, I do this, and I do, and then you know what? I respond by selling my positions, cut my risk. You know what? Because this is a smart thing to do. We're in a drawdown. All right, I'm worried. I want to cut my risk down. Okay, well, that's statistically that might not be the best decision. So this might be an unhealthy response, even though it feels good. It feels like it's right
in the short term.
Yeah.
So in trading tribe, most of the traders are systematic like you, or there's some discretionary guys, and is there a different approach? So for our listeners, trading tribe, I'll talk about this on the outro, is basically a whole, I would say a Van Tharp, who's a psychologist for traders. Its focus is almost entirely on psychology and not who has the latest moving average or channel, right? It's psychology as a trader.
No. Rarely do we ever talk about the markets. We're talking, we do some talking, and then it's a lot of working through the physical feelings that come up either during trading or just life in general. And, we sabotage ourselves in some form or another.
Sure.
We get scared right when we should be being bold, and the opposite sort of things. And these patterns tend to come from early in life, and they're passed down from parents or brothers, sisters, stuff like that. And then we carry them into life. So I had a pattern of shyness, missed opportunity, frustration, and then an impatient decision to get it back, impatient desire to get it back, because I knew the answer, but I didn't raise my hand in school. I didn't pull the trigger when I knew that was the correct thing to do, because I was scared of what? Something, being made
Sure.
fun of, looking stupid. And then I got in a bad baseball accident, and which pretty much ended my baseball career when I was 16. And that was a reinforcing, the behavior I developed from that was not wanting to feel the pain again. I had 3 surgeries. I broke my leg. Had a rod and screws put in, and then all the
At 16,
complications came with that.
You had all this at 16? This wasn't being hit by a pitch
16.
or anything, I guess, was it? Or
no, I was preparing for the draft in 2002, my senior year, and I was on my way to one of the workouts for the pro teams, and didn't make it. Got in a car accident on the way. So,
oh man.
So it was kind of like it was doing this, I got cut down. So, but the response was, I don't want to go through this again. I don't want to feel this pain again. It's like, okay, well, if you don't want to and you're afraid of it, your leg hurting again. Because I played in college. I still played D1 in college, but I wasn't the same. Nothing was the same. So it's like, okay, well, if you don't want to ramp it up and get on the mound and max effort because you're afraid, I was afraid my Achilles was going to snap and or I was going to hurt something else again. It's like, well, okay, then you just run out of time. You can't play anymore because you can't play catch at the big league level. You have to get up there and
totally
do
get
the
that.
thing. So, right. So the same with take it forward to into trading is, well, yeah, I don't want to lose on this trade. I can't lose anymore because I'm getting rocked and I'm in a drawdown. I'm afraid everyone's going to leave me. I don't want to. I'm going to buy this stupid corn or the stupid gold, and it's going to whipsaw, and I'm just going to lose more. All right. Well, then don't do it. And that's in Tribe. We find that the freedom, your personal freedom, exists through that feeling, passes through that feeling of I don't want to do it. I don't want to do it.
Can you say that again?
You want to
your personal feeling is expressed in or passes through that feeling? Because that moment you just described, even those that are listening to this that aren't traders can realize what it's like to be overwhelmed with fear and contradict a proper decision because fear has overcome you. I'd love to expound on that more. I think you just really nailed that.
Yeah, and it so these feelings, even no matter how irrational, no matter how silly, no matter how real they might feel to you, they're just your feeling. There's no they're not based in any statistics or anything. Yeah, you might get hurt again, Mike, but this is the trade you got to make. You wanna play, you have to do this. You want to be in that gold trade. You want to be in that Bitcoin trade. You want to be in whatever other trends are going on at the moment. That cocoa trade the last few years, which is still going on. I still have a position in that. You want to be in these moves that can be scary, that at the moment you get in them, you have no idea that they're going to become this. But if you want to be in that, you're going to have to accept whipsaws. You're going to have to accept drawdowns. You're going to have to accept volatility, getting back and not being at all-time highs every day. There's going to be some pain and there's going to be some discomfort. So you need to cope, learn how to cope with it, accept it. And because if you try to avoid it, you're dead. You're done. You're not.
No question.
You're done. Forget
I want to come
it.
back to that lifetime high in just a minute, but you said something else I want to come back to before that. You make a fascinating distinction, and I'm reading because I'm quoting, between volatility and risk. Volatility is simply fluctuating profits, while risk refers to the probability of capital loss. I would say that most investors on my book of business, maybe yours, I don't know, equate the two. Yes. How can we help them understand? I'm going to read that again. Volatility is simply fluctuating profits, open position profits, obviously, while risk refers to the probability of capital loss, or, as you said earlier, risk of ruin. Let's use this as an educational moment, and please explain that to us. Thanks.
Especially with positive skewed, non-normally distributed returns like trend following. And you get this by cutting losses and letting winners run. This is how you allow for this positive skew. So you're always cutting those losses quick. So you might have a lot of them, but they're not going to be. They're not going to have the magnitude that's going to kill you. But you're going to have these long tail, these few but very large moves, large windfalls of profit. So, okay. So when you have that, the volatility in the winners accounts for most of the volatility in the returns. You're like, okay, so what's wrong with that? Well, we're not going to get out at all-time highs, so we're going to have volatility. We're going to have drawdowns, but over time the equity curve is we hope it's going to go higher. That's part of the design, and but when you have a normal distribution, when you have an equal amount of winners and losses, and volatility matters a lot, because it could be in losses, it could be over here. It's like, well,
right. Absolutely.
Yeah. But when you have the cutting of the losses mechanism, and the other fixed fractional bet percentage per trade and things like this, you're not again, you're avoiding that risk of ruin by doing these simple and effective things that work in nature. They work in the markets, right? That is why I don't equate the two, because when I have an average trade where I risk, say, 0.5% of equity per trade, what's my risk on the trade? 0.5% of equity, right? All right. If it rallies 10% and then I give back half of it, what's the net effect? I made 5% on the trade.
Yeah.
I didn't lose 5. I didn't lose 5. Right? It fluctuated 5. I made money on the trade. So that goes into the right tail. That is a winner.
Isn't that part of the education for clients? Is, guys, those open profits, they're not yours until we close the trade. I know that you think that it's in there. And I've had people say this to me in stock trades. Yeah. But it was up at here. But it was up. I know it was. Why didn't you get out? Because I didn't know that it wasn't going to 190 just because it's at 176 and we bought it at 87. I need these big winners. And again, well, are you trailing the stop loss? Yeah. And I'm sure you have some management just like that. I know Ed does.
Absolutely.
So on these whipsaws, we use this word a lot, and my clients know what that is. We talk about our 1% risk goes through the bottom of the channel and we're out. We don't trade short. So we're either long or we're flat, and we move on to something else. You mentioned drawdowns and the percentage of time in drawdowns. I think this is a misnomer for many people, maybe that are macro traders and equity traders. it is well above 95% of the time, if you look at a 10-year period of time, that you are not trading at a lifetime high. That seems like a duh statement,
Yes.
but that means you're in a drawdown 95 out of 100 trading days, and there are only 252 roughly trading days in a year, right? What would you say to that as far as people preparing their expectations, right? Make it for an easier life if you face that.
Now, I believe I'm remembering correctly. And I don't want to put firm quotes on this, but all right. Talking about Ed, he profiled in Market Wizard. Sure, I called him for the first time in 2013, I believe, and we were talking about drawdowns, and he said, I had a 50% drawdown every year at one point. In the year, I was down 50 from the peak. Now, I believe that he, for years on end, had 200% years for years on end. It was just like a crazy time in those 70s, 80s, and he was very high octane, very aggressive. And so we had these massive drawdowns regularly. Now, that would probably make most people sick. But yeah, if you want the fruit, you're going to have to put up with these storms. You just, there's no way around it over the long run.
And
in the short run,
sure,
you can get lucky. You get a stretch of nice weather where it's all rosy. You do no work, you feel no pain, and you make all this money. But that's just not. You live long enough, you're gonna have scars. That's like the curse of survivals. You're gonna have scars on you.
Exactly. And the alternative is you don't survive. You don't want to survive.
Right.
I'd rather have scars than survive. So you mentioned 0.5%. I actually risk on my macro program 0.3%. Was Ed having a 50% drawdown on 0.5%? I've heard that he never risked 1%, but I thought he was more like a 0.75%. And this might surprise those of you listening that, gosh, you're only risking that amount. Well, yes, when you can have a string of whipsaws that's 20 to 25 long. And yes, it does happen. That's what the probabilities are. Why do you think casinos never go out of business in Las Vegas? They've done all of these probabilities. So, but if you want to comment on that, just getting used to the fact that you're single digit days in a year that you're at lifetime highs, and then it goes back until the next time goes, right?
Yeah, that's okay. And I think that's one of the motivating factors of diversification in general. Don't just diversify if you're just trading stocks, like the stocks you invest in, but then move it upstream to the strategies that you invest in, and you try to make a smoother, better performing basket over the long run by not being in just one thing. And there might be times where you're going to underperform something because you don't have all of your money in the best performing thing all the time, but you need is one of those coping mechanisms. You need to be able to just cope with, I know we're not going to be at all-time highs all the time. And you know what? Is there a proactive way we can handle that rather than just, hey, Charles, you better figure it out. Otherwise, I'm out of here. Like, that is not proactive. That's not healthy. And it's not going to get anywhere.
Well, I agree with that. Do you have clients that maybe not now that are still clients, right? But did you ever have clients like that you had to basically say, you have to fire them?
Yeah.
I've had to fire clients because it's mentally messing with your mind. It's like, we've tested this. We understand it. Realize that most of the time, and this is Tom Basso, who is really a tester. I'm sure Sakota is too. It's 67 to 68% of the time. That's almost 70% of the time. The markets are random. And even if they're not random, they're not making huge moves. The big moves, 3 or 4 big moves in a whole year make it. That's why Ed Sakota, for those of you that are not, I will put in the bottom of this video the link to the Whipsaw song with Ed Sakota on banjo.
Good one, yeah.
I've listened to that a dozen times, I'm sure. I'm not sure that one good trend pays for them all. Maybe two trends. I would debate him on that, but it depends, right? So
Depends. It depends. They all depends. But yeah, that's the gist. You get one good set of trends, one good trend, depending on how much capital you got invested, the size of the drawdown, size of the trend, yeah, all that. But yeah, that's another tribe. Another tribe. I say another saying from the guys in tribe is trend following is the systematic attrition of capital with the occasional winning streak.
that's
So
a
you're
fabulous way to put it. Yeah. And then a spike.
Boom.
Yeah.
Boom. So that is the right tail. Like, and if you visualize, drew your hand doing that, and then did that, you would draw a positive skewed right tail. So that's how it is.
I think it's fair. Somebody's going to be asking this question. You just made that, diagram, right? But somebody's on the other side of that trade, or are they? Is that a conglomerate of trend faders, people that are buying the bottom of the RSI and selling the top of the RSI when we're buying the top? And, there has to be a mindset that is succeeding at that in these years, and they think that they're geniuses because it's been working so well, right? The opposite of trend following is trend fading,
Yes.
or whatever you want to call it. Maybe talk about that a little bit.
Yeah.
Maybe you have some, because you're in New York, you probably got a bunch of buddies that do that, right? So
counter trend, hedging, where they're losing money on purpose because they're hedging the price risk of their product, the underlying product. Say an airline is hedging their costs that they'd have to pay for oil. So
but they don't care because
yeah, right. They don't care. Right. They're not trying to make money on it. They're not going to become trend followers and try to catch that.
Well, the farmer, if he sells soybeans in the market at $9, and it goes to 14, it's like, well, I've got it in the cash market. I lost in my futures account. I just didn't make anything, but I'm not in the business to be a speculator. You guys can do that. And it works that way with Kellogg's on the other side. They're buying and they don't care if the price went down and the, farmer or whatever. They're just there to hedge their risk.
Yeah. So I know some guys have used we trade counter to the hedgers. Trend followers trade counter to the hedgers, and they're the ones that provide our profits. But I think it's not necessarily just the hedgers. It could be other speculators too that just, like you say, like buy when the RSI is low and sell when it's high, and they're just counter trend in their own style of trading. They don't necessarily need to be hedgers. Or, just when people make mistakes and people enter the business for a short time and they want to get in on the action, and you have that relationship between the fundamental, the value investors, and then the trend traders that produce these moves. Value guys will be buying before we do. We're waiting for the trend. Value guys are buying down, and then eventually stops, and you get buying pressure up, and then the trend traders jump in and they push it even further. We don't know who's on the other side of our trades, but I believe it was John Henry a long time ago. He believed that, at least at that time, that they made money from the overreaction, underreaction of from investors on particular moves, and so I think he was going towards the psychology reason route,
making money on poor emotional decisions. Basically, is what you're saying, right? So,
yeah. Yep.
So in a year like 25 here, we have unprecedented monetary policy where you have a president literally lambasting the chairman of the Fed, right? I don't think it's not happened in my lifetime, and mine's older than yours, right? We have the geopolitical tensions at the same time. You have a president using an F-bomb, which is not the most played video right now, talking about someone who was an ally, Benjamin Netanyahu, 2 days earlier. And so then the market gaps down on Monday because of, these bombs dropping, and then it closes higher at the end of the day. I mean, What changes other than volatility bands? I mean, it doesn't really, at least doesn't change my position sizing goes down because the bands are expanding, which means the risk parameters change, which means less number of contracts. I would think it's the same for what you're doing.
Yes.
In other words, your technical fill in, they handle the emotional part for you, so you don't have to be trying to play into how's this geopolitical thing going to affect us or how's Trump going to affect us. Tariffs.
Yes, the tactics on what to do are always they're always mapped out ahead of time. Now you might get in and out for reasons that were different from before. Now it's some reason. Before was something else, but that doesn't remove the emotions from having to do it. You still need to put the trades on and take them off and adapt your position sizing to your new level of equity or the new volatility in the market, or each market that you're trading. So, trend following in general has a great deal of survivability built in, but that doesn't mean, oh, this is easy. No, you still have to do it.
Let me ask you a particular tactical question. If I use stop limits most of the time because they're gap moves and I think the market's going to retrace and I'm going to get filled where I quote the system would have filled me. But there are times like in Solera, you mentioned Bitcoin. I trade Solera, Bitcoin, and Ether in the futures markets where it just gaps and just sits there and you're going, oh, let's see, I wasn't filled. And you have to make a decision. So do you generally stop and reverse with stop orders or stop limit orders? Just curious from a tactical point of view.
Stop orders. Yeah.
Okay.
I'm too nervous, and you risk missing a trade too. I think I have had maybe the one I can think of is no, I was filled on that. I remember. Oh, this is what I remember being worried I wasn't filled on the Swiss franc in 2015, I believe it was.
Okay.
When it gapped higher. It did whatever it was, like a 10 sigma move in a day or overnight. It was something crazy. And I remember I said, "Oh no, I don't know if I was filled. It doesn't look like." And then it was. It's still there was a gap and where
like 40 pips slippage is what you're saying.
Yeah, something serious, but at least it was filled, and so that got me like, oh yeah, geez, what do you do when you're a big fund and something like this happens to you? How do you maneuver this?
You would need to go in and change your size, right? Because if you'd positioned, okay, my risk is 120 pips, but my fill was a 40 pip slippage, wouldn't you go in and reduce your contract size? Because you were slipped 40 pips higher than your range of your loss. And we're getting into the weeds on a little bit, but do you adjust a trade afterward if you have a lousy fill like that when the market's just, moving super aggressive?
What do you mean adjust the trade?
Adjust the position size. So if you're into a position, like you work with 10 lots, but your buy was at spot 9,600 and you got filled at 9,650, it's like, well, I'm taking on more risk now, so maybe I need to drop that to 9 lots or 8 lots. I don't know. I'm just curious tactically if you'd do that.
Yes. I thought maybe you were thinking for like the next trades because you...
No, you need to modify that trade. And then, of course, the next trade is also going to be dropped because that band is, So I'm interrupting you. Yes. Sorry. I just want to cover some of this stuff.
And generally, at least, to get more in the weeds here with the... this is another reason why I trade very long term, trading on average each market only one to 3 times a year. If it's a bad year, it's like 4 or 5 times. A lot of more whipsaws.
Was there more whipsaws? So does that imply almost all weekly signals? Because I would say 70% of my markets are weekly signals. I don't use any monthly signals, but if you're trading 3 or 4 times a year, that sounds like monthly signals or at least weekly.
I use daily. They're just long term signals. It's less
Yeah,
sensitive to the moves.
sure.
But when you use more sensitive parameters to get in and out, you get in and out more frequently, and your time frame's shorter. You'll see if you're doing some testing, just increase your skid fraction, how much slippage you're taking on
Right.
each trade, and those systems degrade much sharper
Yeah.
than the longer, less infrequent. So yeah, if I get a bad fill, eh, you know, and it's going to be in like rice
Sure.
or uh, orange juice,
You're not going to say
you
just going to
know.
say orange juice. You're not trading lumber. I can't imagine. And even juices. Uh, for those
Yeah.
of you that are not familiar, these are called these soft commodities. Not like you
Hmm.
can't pet them or anything, but cotton and cocoa and sugar and orange juice. And
Yeah.
these are what we call
Tropicals. Yeah.
illiquid. And you might say, well, it's orange juice. How can it be illiquid? Okay, so that means the number of contracts traded daily. So it's interesting. I have a family relative that would participate in those because he owned a grapefruit production facility in South Florida, a big one, like over 150 trucks delivering grapefruits. And he needed to hedge this. And even though it's not a direct correlation between orange juice and grapefruit juice, it still was a hedge. But he would do that. But even back then, it was illiquid, like you're saying. So, and some of the overseas markets, not as liquid as obviously T bonds. You can trade anything at any time,
Right.
or SPOOs, futures,
Yes.
and QQs. So,
Right. Um, so yeah, I would just, that's just an aside for, maybe the traders out there, if there's any listening to, really take a look at that. If you're trading more frequently, look at that skid fraction percentage that you're working into your test, and you'll see as you ramp it up, those short-term systems get smoked. The less frequent, less sensitive long-term systems hold up well, even if you work in a lot of slippage,
yeah.
because there's
Okay.
not as many trades.
So speaking of
So,
hanging in there no matter what, I'm going to quote you again here.
oh boy.
Managers must show up even when bloodied. I love that. You got to show up even when bloodied, because that's a skill that many clients don't have, and we need to be there for them. I thought that was very altruistic as well as true. You want to expand on that a little bit? That's great.
Yeah, another personal, I guess, feeling I had for a long time since I was a kid, and I don't remember when it came from, but I, perfectionist trait of not wanting to bring home a bad test grade. It's just so embarrassing.
Yeah.
I hate it. They're gonna yell at me. Everyone's gonna think I'm stupid. All those things that come up, and it could be another on a deep level why why I got into trend following, as well as just wanting to win, and something in it spoke to me, but it also in a weird, funny, not so coincidental way helps me to get comfortable with this feeling of, you're gonna have to show your losses too. you know, you don't just show your good stuff. your your positive months, your positive trades. You got to show all of it, and it's gonna get nasty at times. But um, this isn't a test where it's like school, where there's an answer. You guys are gonna memorize the answers, or whatever. However you get graded and stuff. The markets are much more complex than that. It's not the same game. It's not even the same as
Sure.
sports. It's so you need to come to accept that you have no control over the markets. So you can't take full responsibility for your losses as well as your winning, right? Because you're not in control of these things.
Well, we're not in
You
control of
are in
that
control
cocoa
of is
trade. Let's just agree on that. That
sure,
that cocoa trade,
sure,
which is why we should not, and we tell this to you clients. I've had some biotech stocks that are like this cocoa trade that both of us talk about here, but I can't take credit for that. I just happened to buy it, and then it just happened to be bought out. At the time it was bought out, 4 months later, it might have been in motion, but it might not have been in motion. It might have been a 1 month deal and it was closed and nobody knew what was going to happen. So if you take credit for that and say you're a genius, you're not only fooling yourself, but you're misleading your clients.
And cocoa, historically, on any systems, trend systems that I've tested over the years, cocoa was literally the worst market to trade. The worst. Now
Really?
I have this massive 5x move that happened. Most guys, if they're optimizing their system or overfitting, they wouldn't even included it into like, I'm not going to trade cocoa because it stinks. Look at it. Look at the results for the last 40 years. It's terrible. Why would I trade it? Because all it does is lose. Yeah, you see? You can't predict. These are the right tails that can come out and really drive you mad if you're really only looking at the past, only limited amount of data you have, and say, yeah, you see, this can't happen because it hasn't happened. Like, you need to expand your imagination a bit.
Sure.
Because new things are happening all the time. And this is why, take it to nature and take it to just, I want to say common sense, but just think about it a little bit more. Don't get so wrapped up in a back test and think that everything that could have happened in the history of the planet has happened right here in the last 30, 40 years of futures data that I have. Oh, really? Like, I think you saw the post the other day. Oh, yeah, you did. When I took a picture from the Amalfi Coast of the slabs of limestone.
Yeah.
Each slab of limestone, each layer takes hundreds of thousands to millions of years to form. Like, you think things went down in that amount of time. What is 30 years? What's 40 years?
It's just that it's our 30 and 40 years. I get that. I want to go back to
I understand that.
To the baseball. Yeah. Do you think that, because it sounds like you were a pitcher. Is that?
Yeah, pitcher, yeah.
Okay. Mm-hmm. So if I'm right on this, I'm not going to be exactly right. You can be a football player, star quarterback, Tom Brady, and have a 68% completion succession, which is only 2 out of 3, and be a phenomenal success. Mm-hmm. Michael Jordan, our Chicago star, had a free throw at 52.5%. Ty Cobb, the only baseball player that I can remember, 416 to bat 400. And if you bat 333 today, you're making 14, more than that, probably 20 to 25 million a year, right? If you're batting 333?
Probably, maybe 50. Depends on what you're slugging. Depends on what your slugging percentage is.
Right. Yeah. And you know all that better than I do. So my point of where you see where I'm going is, just because the winning ratio is low, if that 333 comes with 3 batters on and your slugging percentage, they would call it in baseball, is high, they don't care if you strike out or ground out. They prefer you not hit into a double play, but we're using this metaphor. You see where I'm going with this. It's what the overall result is. And that has to be quantified. I mean, was it Jerry Maguire or whatever is the movie where the statistics started being literally evaluating. They've done the math on what a successful baseball player is. We're trying to tell our clients, we've done the math, the back testing and the research on this strategy working. Maybe talk about that a little bit, because I'm sure you've done a ton of that over your career.
What is, going, take it further, take it to nature now. What's the rate of success that multiple lions will have in a hunt? If they have 10 hunts, how many on average do they get?
Gosh, I'm going to guess and say 2. Is that too low?
3.
Oh, it's close. Okay.
Close, right? So pretty low. And then a single lion is about a little less than that. So like 15 to 20%. So half of that versus, at the low end, half of that versus multiple lions were, great. They double it and now it's 30. That's a lot of work. But again, you need one big kill does the job. So what do they do when they make a big kill? They protect it, right? All their boys come in and they guard from the hyenas and the whatever other scavengers come in.
Sure.
They devour it, they protect it, and that's all they need every once in a while is a big kill. And they're top dog, top cat, but you get it.
Yeah.
So yeah. I think now I forgot what the question was.
Well, we're just rambling. The winning percentage
Yes.
that actually kind of help you as a baseball player, as opposed to a football player who, if I'm going to be a star, I gotta have a 67% completion rate, whereas
Yep.
A hitter at 333 is colossally successful, right? Earned run average of 2.4, I guess, is also colossally. You might say, well, you're giving up 2.5 runs a game. You're going to lose those games. Somebody doesn't think so because they're paying me $45 million for that data.
Yes. Okay. So I did I think I know what you're referring to, the Pareto principle.
Yeah, exactly.
So I wrote something on this because it's not that I needed to know. I wasn't going to use it for anything tactically. It helps. It helps when you talking to investors and saying, okay, just to help you get an appreciation for how this works. Because when something happens that you don't like, it doesn't mean something's wrong with it. It just means that you don't like it. They're not the same thing. Because I have it too. I hate it when I lose. I hate it. But that doesn't mean it's broken or wrong or anything. So I want to check and say, what percentage of the trades account for most of the gain across the entire back test? And as you can imagine, it's very low because
single digits or very low double digits. Yeah.
Yeah. So I want to try and pull up this paper.
Sure. Go ahead.
I'm trying to remember. Trying to remember exactly what I said in there, because I remember the one thing I did was I looked at the P&L in terms of dollars, which shouldn't do that because over the life of the test, the account equity grows, but you have the more recent trades, sway, have much higher weighting than the previous, than the trades in the early years where you had much less capital. So it's not fair to use the biggest 3 trades account for 80% of the P&L. Yeah,
it's like an exponential chart versus a simple moving average versus exponential moving average. Yeah.
Yes, you really want to use, say, like R multiple or the N, the ATR capture or the P&L contribution to the system. That's you want to normalize it,
sure,
like that. So in this example, if I summed up all of the R multiples, and this is across over 9,200 trades. All right, so you have a sum of about 4,000 R multiple. 4,000 R multiple is the average P&L divided by the average risk on the trade in terms of percentage terms. So if you're risking on average 1% and you made 10, your 10% your R multiple is 10. So they're not all positive too. Some are negative. So I wanted to see, okay, what percentage of the trades account for most of it? What's most of it? I don't know. 80% or something like that. So 80%, 400. sorry, 4,000, you get 3,200. And you say, okay, how many there? And, as you know, it's a very small percentage of the total trades. It's, let me see here, and I can just try to find this real fast.
That's great. No, go ahead. Take your time.
Yeah.
I think it's useful for people to see this percentage is
Still going
shockingly
down.
low.
Still it's shocking. It's terrible. It's not a pleasant feeling, because you want it to be normal and you want them all to win.
So as you're doing this, I'm picturing myself interviewing a lion and him saying, he's kind of lean. It's like, well, I'm in a down draw, and maybe he calls it a down draw. We call it a drawdown. Been out on 8 trips and I haven't caught anything. But the next one, right, probability wise, we've done the the math on this, Mr. Brown, and we think we're going to have a really good catch this next time. But we're lean right now, and for us it's survival. So believe me, we'd love to increase these odds if we could.
Okay, so here it is. It's worse than I remember. It's terrible.
No, read it. People need to hear it.
Less than 3% of the trades of the almost 9,400 trades. Okay. Less than 3% of those trades, 2.82 to be exact, account for 80% of the total P&L of the entire P&L.
So it's not on a calendar year. It's 9,400 trades over what period of time? Is that 24 months, 36
From
months?
1980 through present day.
Today.
Okay.
Yeah. Wow.
Today. Yeah. Mm-hmm.
And the drawdown during that time was what? The worst case drawdown? Is that also in the back test here?
Oh, yeah. I think the worst case was 63%.
Wow.
As an aggressive, this is an aggressive system.
Still a 0.5% risk per trade, though? 0.5% net lick?
Yes.
Okay.
Yes.
Adding to winners at all? Adding to winners or constant position size?
No pyramiding in this.
That's what I meant, yeah. Not Richard Dennis.
No pyramiding.
Yeah, not Richard Dennis. Okay.
Nope. Using core equity, that's another big one. That is, I don't even want to give that secret out, even though it's not really a secret, but people won't even do it anyway. But it's basically just thinking about your assets and liabilities and what is your net worth bet according to that number, not your assets.
Interesting.
Mm-hmm.
Okay.
Mm-hmm.
I want to get to 2 more things here at least. I mean, this is great. We could go on for a while. One of your comments was, I need a 5-year commitment. You recommend that investors view it that way. And if they can't do that with you, then you just need to tell them, you know what? Then I hope the next guy or gal that you trade with, stocks, futures, Forex, whatever it is, you got to give them 5 years. Because you could come in right at a downturn. A lion joins. Now I'm going to be on this roll the whole night. A lion joins the whatever they're called tribe and goes out on a hunt. In the first 8 hunts, he's starving because we just had a great kill before you joined us, and now we're in a drawdown. 5-year commitment. You think that's reasonable for anybody in any commodity or equity?
Yeah, I'd say that's the minimum. Minimum you'd have to have. In any investment. And even then, you could lose. It could just be a bad time. Normal. So I'm going to use that same system that I just used to calculate, use that Pareto principle example. This system, very simple stuff. 5-year, it has 475 possible 5-year holding periods. Okay? From 1980 to now. It was profitable in 96.6% of them. But the worst period for the 5-year was negative 42%. Now, knowing this now, you'd say most of the time almost 100% of the time. In this test, theoretically, this assumes you'd follow it like a Marine, no matter what. All right, and that's a whole other thing.
Minimal slippage involved, etc. Yeah.
Yeah, I work in all that stuff, and fees and everything, to make it as real as possible, theoretically. Right? Because again, you can have a great diet and fitness regime. Well, why don't you do it? Well, I don't. It's tough. Yeah, it's tough. So this system is just theoretical. It assumes you'd follow it every trade. So you have a very successful 5-year holding period. The odds of making money over any 5 years very high that you at least make some money. But it's like I just said, its worst period was -42 in this case. So.
And you could have started in that period. That's what we need to tell people. You have no idea when that is. And people say, well, why don't you know? Well, if I knew, the person on the other side of the trade would know and wouldn't take my orders. That's a very simplistic view, obviously. But that kind of gets me to the next topic that I want to make sure that we cover, and that's AI. Obviously, that's going to affect our industry. We use it all the time. I'm guessing you do as well. But what I tell people is if the machines just purely start trading with each other, nobody's going to take the other side of the trade. The reason markets work is there is a two-sided bid and ask, bid and offer, whatever. It's going to be wider in some markets, like Solero, than it's going to be in oats. So the risk is commensurate. If you're making a market on both sides, you're going to have a wider bid offer if there's less volume. But the reality is that if it's all AI participants, 100%, how will the market not just grind to a halt? What are your thoughts on AI not helping us? But in other words, I go back to my favorite two words. I'm using it to supplant what I do, to supplement what I do and not supplant what I do. I think it will stay that way for the rest of my life anyway.
No, there'll be trends, no matter what. AI won't matter. It might make it better per trend, because you'll have, let's say, and the big elephant in the room is the government intervention with the help of central banks and every other mechanism they have at their disposal to conspire to make the markets do what they want to do in their favor.
And I hear you, but that's financial markets. I mean, today I mentioned the soybean trade earlier where it gapped down because of a supply issue. I guess they can regulate, USDA can come in and make comments and, favor long or short positions in grains. Are there some markets that the government can't affect? Is Bitcoin too large? Probably not, because it does tend to gyrate around based on Fed statements in the same way the dollar does, or the yen or Swiss or anything else.
I think it's, going back to, like we said before, tulips, those 500 years ago, wherever it was, 400, 1630s, I think it was. And I know that, not because I know the tulip mania like the back of my hand, but on vacation I was reading about the island at the center of the world. It's a book. It's about the island of Manhattan and how it was New Amsterdam, and it was ruled by the Dutch for a while before the revolution came and then all that stuff. But back then, you had massive bubbles, and they used to get around on ships, and then we moved to horses, and then we moved to automobiles, trains, planes, and now we're moving. You get information that took a week to a year to get to, and then now we have, information at the speed of light, or I don't know if that's exact, but it's very fast.
Well, we have jets that can fly 30 hours one way and refuel in midair and then come back to Missouri. We just learned.
And still, what do we get? Trends. Right?
Yeah.
Still getting moves despite how fast information is traveling, because you have at the end of it humans involved, and they have their own problems. They have their own emotional problems. They have their own real life problems too. business risk or whatever, their own, greed and fear and pride and envy and despair and all these things,
Sure.
that have a real. It doesn't need to be logical, but they have a real effect. And it doesn't mean you give someone AI and they're all of a sudden become Albert Einstein, like they always do the statistical correct thing. Absolutely not. No, no, they're not gonna, because that's not how we are. Because it's about survival on Earth. I need to eat. I need to be right. I need to not feel this. So that drives behavior.
Yeah.
That is not stopping because someone has AI in their hands. No way. No chance.
So let me exit with this one for folks. So you mentioned in some of the things I've written, read by you, that you have written, and I'll have the link, guys, down in the bottom here of the show for Michael's webcasts and things that he does. You really want to pay attention to it. That's how I discovered him. You mentioned the importance of personal growth through challenging markets. What have the past few years and even this year taught you as an investor and a business leader, and how do you see that continuing to evolve going forward?
What have I learned? A lot.
Specifically in trendless markets. I mean, the frustrations of trendless markets, I guess. It's a time for personal growth. You mentioned it earlier.
Yes. It's been a challenging personal time because, hey, it's who I am. Where I want to win, I hate losing, and growing up in sports, you either win or lose.
It's binary.
But yes. Now it could, before about going over to the dark side. You need to stay away from this because it can be dangerous for you and very unhealthy. And I think a lot of traders have this issue as well. Is do not, when you lose money for whatever stretch, some stretches go longer, some go deeper, some whatever. You cannot say to yourself, I am a loser. That is different than my system's losing. Experiencing losses in the market. You cannot say I am a loser or something like that.
It's horrible for your mind.
You attach.
Yeah.
Terrible.
And I would even go further than that. I don't even say I have a loser trade. Oh, that's a winner and that's a loser. I have a winning trade and losing trade. It's a subtle but important because it's like I don't even want to hear this word loser, because when you see that word loser, you hear someone going loser. It's used on TV sitcoms and all that. And when you hear that, I don't know about you, but at my age, I just shrink a little bit. I feel like I need to. There's shame attached with hearing it, even if you don't feel it.
Yes.
And then if you're in danger of embracing it, and now you're really in trouble. Sakota would say lethal,
Yes. Words have power, and that's
absolutely
a lot of the, not say a lot of, but it has a place in tribe as well, because you say these things again. You keep saying them, because your dad said that to you when you were a kid. You'll never be able to. You'll never make it in business.
Right.
This is a tough business. It's going to take a long time for you to get this, because look, there's a lot of people that are, well off and they had a head start. Yeah, you're right. Yeah, you're right. I am behind. Yeah, this is going to be tough, and you start to believe it. Like, that's incorrect. You absolutely cannot take on someone else's programming and make it your belief. And that's, your beliefs and attitude tend to shape your world. And some people just are presented with a drawdown and they say, hey, great time to get in. This is statistically a great time. And you know what? Yeah, we had the fund closed because we've had a lot of people in, but now people are leaving, and maybe we'll open it up again and get some people in, because I believe, going on statistics here, this is the correct thing to do. Allocate at this time.
Going
Versus
on
the other guy who's
statistics.
just like,
Yeah, exactly.
yeah. Versus the other guy who's just like, man, this is, what am I doing with my life? You know, this, I can't, you know, like, it's too hard or whatever, you know, boom.
So this has
Same
come to me.
event, different attitude.
This has come to me just in this interview as we say goodbye here. I think we're on to something. You need to approach Tony Robbins and Kevin O'Leary and say, we're going to start a trading tribe for clients. And offer that as a psychological retreat for people, a 2-day retreat on how to get your mind properly tuned to be an investor. Tony Robbins, perfect guy to do it. Take it to Shark Tank. O'Leary, because he's in finance, probably would jump on it. What do you think? The trading tribe that we've been talking about here, if you guys haven't, you can Google it and you'll see Ed Sakota started these for traders to go to. It's kind of a closed circuit thing, but this could be a much bigger, and as they would say, scalable opportunity for people to go and literally have and focus specifically on investing. There are all kinds of, help seminars, but just to properly write yourself on everything you've talked about today as an investor, I think people would come out a lot healthier, right?
Yeah. Yeah, I think talking about it is one approach, but you got to get in the hot seat and get into those feelings, into those forms. And that's where the real magic happens, where you get real insight and you don't necessarily need to be talking about it. Conscious mind. Let's figure this out. Let's dig into this. Let's find it in there. Where did this come from? Let's, all that type of stuff, which smart people love doing.
Sure.
Versus jump into those feelings, baby. And don't need like drugs or anything. That's a popular route too. Let's bliss out and we'll find it. It'll come to us. Maybe. But this is just another way. Tribes is another way of cranking up the heat. And then like a volcano, it's going to come out. It has no choice but to come out somewhere.
Right. Well, think of it as physical fitness for your mind, right? For your psyche.
Mm-hmm.
I mean, the trading tribe, he's talking about the hot seat where during the course of the meeting, everyone gets to go down and sit in the hot seat and have basically an emotional tirade, get it out of their system, and then accept criticism or comments from members. Anyway, if we could market that, maybe we should. So much to think about.
I have to run it by Ed and see what he would do. He would not allow anyone to charge for it.
Well, yeah, I get that.
Not allowed to make any money on it.
And obviously, I'm half serious, but I think it's a concept.
Yeah.
You have given us so many jewels of tidbits of information and then overarching concepts to ponder, Michael. It has been a real treat to talk to you, and I know my audience is very grateful. And I hope they'll go to your site. And at some point, you're writing a book, and whenever that comes out, we will put it on our site for all our viewers to see, and sell 1 billion of them if we can for you. So
that's a lot. Yeah,
I understand. Thanks so much for being here, my friend, and we'll see each other next time.
Thank you very much. This is fun.
Well, there you have it, everyone. Michael Melissinos from New York City, a well-known trader and a little bit of a philosopher too. A lot of what we do in this business is manage expectations. Much of market movement is random, and predicting it is futile and frustrating. So a lot of our discussion, as you saw in this interview, talks about the psychology of not only being a money manager or portfolio manager or futures trader like what Michael is doing, but also it involves discipline with our clients, understanding that we are in the business to manage expectations and wait for the right market conditions to come along where our strategies can bloom. Every strategy works in some situation, but ours, well, we need those to work in the right situations at the right times, all right? So we test a lot, And that's what we are bringing to you as the results of our testing and our methodology. I hope you learned something. I hope you give it a second listen and come away from it encouraged and ready to continue in this ongoing journey we call investing. God bless you guys. We'll see you on the next episode.